Commercial banks. Now, in India, there are various commercial banks which businesses can use to get short-term or medium-term loan or their basic requirement funds. Now, commercial bank assist corporate enterprises. How? By granting term loans to companies, by subscribing to shares and debentures of companies. So first is the banks can give loans to the companies, and the second is they can buy shares and debentures of the company. Third is by underwriting the issue of securities of the company. Now what is underwriting? So in security market, underwriting involves determining, analyzing risk and price of a particular security. Now here what happens, it happens usually during the initial public offering, where investment banks first buy or underwrite the security of the issuing entity and then sell them in the market. So in simple, it means that commercial banks will take certain type of guarantee for selling the securities of the companies. Means they will buy the securities if it is not sold in the market. Now, disbursement of credit by banks. So first is overdraft. Now, the borrower can withdraw funds as when needed. He is allowed to overdraw on his current account up to the credit limit which is sanctioned by the bank. Now, this facility is given to the current account holder, where they can withdraw the amount from the bank which is more than the amount which is already there in the bank. Means, for example, if the amount in your bank is 10,000 but you need urgently 12,000, means you need additional 2,000, that 2,000 will termed as overdraft. Then cash credit. The borrower can withdraw the amount from his cash credit account up to a stipulated limit based on the security margin. Here, if the bank gives certain cash credit limit, like you can withdraw more than 10,000 from your account. So that is a maximum amount that a person can withdraw from the account. It is 10,000. That is credit, the additional amount the bank is giving to the person. Then cash loans. Under this, the total amount of the loan is credited by the bank to the borrower's account. Credited means the bank will send the amount to the borrower's account, and then interest is payable on the actual balance outstanding. So it is a type of loan. A company will take a cash loan and bank will directly send the amount to the company's account. Then the company has to pay certain interest of the balance which is outstanding, which is yet to be paid. Then discounting bills of exchange. The drawer of the bill, that is the seller, can receive money from the drawee, that is the buyer, on the due date or after the due date. Drawer can receive money before the due date by discounting the bill with the bank. Now imagine the bill was supposed to get, and like the maturity date was say 1st March, but the seller requires money on 1st February. So the seller will go to the bank and will get the money before due date. That is known as discounting of bill, which can be done with the bank. And bank will take certain amount from the bill also. So the bank will give less amount to the seller, means the drawer, because bank will take certain amount from the face value of the bill. Such bills of exchanges are also known as trade bills. They are accepted by bank and cash is advanced against them. Financial institution. Now, after independence in the year 1948, India's first industrial policy was declared for the rapid industrial development in the country. Now, central government and state government have established special financial institutions for providing industrial finance. So, central government of a country and state government of various states have come together and they have set up financial institutions which will provide finance to industries for the growth and expansions. So classification of financial institution, so there are various types. So first is development banks such as Industrial Development Bank of India, IDBI, then Industrial Finance Corporation of India, IFCI, Industrial Credit and Investment Corporation of India, ICICI, Small Industries Development Bank of India, SIDBI, then Reconstruction Bank of India, IRBI. So all these are developmental banks which will give credit and funds to the businesses dealing in various industries like small scale industries, medium scale industries, and even huge industries. Then there are financial institutions. First is Risk Capital and Technology Finance Corporation Limited. They provide finance to the businesses. Then Technology Development and Information Company of India Limited, TDICI. Then Tourism Finance Corporation of India Limited, TFCI, which deals in the finance of tourism. Then there are investment institutions in India like LIC, Life Insurance Corporation of India, Unit Trust of India, UTI, General Insurance Corporation of India, GIC. Then there are some state level institutions also like State Finance Corporation, SFC, State Industrial Development Corporation, SDIC. All this look for the finance at the state level. So what are the functions of these financial institutions? To provide term lending facilities, means to provide loans to the businesses, to the industries, to subscribe to shares and debentures, to underwrite the issue of securities, to lend money, to guarantee term loans raised by the company. So all these things are provided by the financial institutions which are set up with the help of central government and state government.